Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the secret codes buried in corporate filings. Today we're diving into the York Water Company's latest report, and let me tell you, it's a real page turner, especially if you like numbers and the essential service of water. They've just filed their quarterly report, and it gives us a snapshot of their financial health for the period ending the 30th of September 2025. Think of it as a checkup for a company that keeps the taps flowing for a lot of people. Let's see how they're doing. First up, let's look at their balance sheet. This is like a company's financial diary, showing what it owns and what it owes at a specific moment. As of the 30th of September 2025, the York Water Company had total assets of about $667 million. That's a lot of pipes, reservoirs, and treatment plants. A huge chunk of that is their net utility plant, which is over $559 million. This is the backbone of their operations, the actual water infrastructure. They also hold over $88 million in other long-term assets like deferred regulatory assets, which essentially means money they expect to recover from customers for past or future investments. On the other side of the balance sheet, we see $238 million in total common stockholders' equity. This is what the owners, the shareholders, effectively own. And then Therese long-term debt, which stands at over $226 million. Companies like this often use debt to finance big infrastructure projects, so this isn't unusual. Now let's move on to the income statement. This tells us how much money they made and spent over a period. For the 3 months ending the 30th of September 2025, they brought in about $20.4 million in operating revenues. That's up from about $19.7 million in the same period last year. And the bottom line for that quarter was a net income of $6.2 million. Not too shabby. Looking at the bigger picture, the 9 months ending the 30th of September, 2025 shows operating revenues of nearly $58 million with a net income of about $14.9 million. This is a slight decrease from the previous years, $15.2 million for the same period, but that is not too alarming considering the scale of operations. One of the bigger expenses they have is depreciation and amortization, which was over $10.6 million for the 9-month period. This is basically accounting for wear and tear and the cost of their massive infrastructure over its lifespan. Interest on debt also took a significant bite out of profits, costing $7.5 million for the first 9 months of the year. This is directly related to that long-term debt we saw on the balance sheet. The statement of cash flows is crucial because it shows the actual cash moving in and out of the business. For the 9 months ending the 30th of September 2025, they generated over $21 million in cash from operating activities. This is a healthy sign showing they can generate cash from their core business. However, when we look at investing activities, we see they spent over $37 million on utility plant additions. This is money going back into the infrastructure, expanding and upgrading their water and wastewater systems, a necessity for their business. Financing activities show they took in over $43 million from issuing long-term debt and also repaid over $22 million. They also paid out nearly $9.5 million in dividends to shareholders, which is a good sign that the company is profitable enough to reward its investors. Let's dive a bit deeper into their debt. They have various bonds and notes outstanding. For example, they have these variable rate Pennsylvania Economic Development Financing Authority, exempt facilities revenue refunding bonds series 2008, are due in 2029, totaling $12 million. They also have a committed line of credit due September 2027. This is like a backup source of funds. As of the 30th of September 2025, they had borrowed over $37 million on this line. This shows they are actively using this credit facility. Now this is interesting, they have an interest rate swap agreement. This is a financial tool used to manage risk, usually by converting variable interest rates into fixed ones. They are using it to effectively make their $12 million variable rate debt behave like a fixed rate. This helps them predict their interest expenses more accurately. This swap is set to expire in October of 2029, so it's a medium-term strategy to manage their interest rate exposure. The company also discusses the fair value of its financial instruments. Essentially, they are valuing their interest rate swap. As of the 30th of September 2025, the liability associated with this swap was valued at about $510,000. They use observable market inputs for this valuation, which is good practice. Under commitments, they talk about a program to replace lead customer-owned service lines. This is a really important environmental and public health initiative. They are replacing up to 400 of these lines per year and recording the cost as a regulatory asset to be recovered from customers. This shows they are proactively addressing infrastructure issues that affect customer safety. The estimated cost for this program is around $2.1 million. Let's break down their revenue a bit. They've disaggregated it by water and wastewater utility service and by customer type. Water utility service accounts for the lion's share of their revenue. Residential customers bring in around $11.3 million for the water utility service in the third quarter of 2025. Commercial and industrial customers contribute another $5.6 million. For wastewater, they generate about $1.7 million from residential customers and a smaller amount from commercial and industrial users. It is important to note that they also offer billing and revenue collection services and a service line protection plan, which adds a bit of diversification to their business. This section on rate matters is critical for a regulated utility. They have a rate request pending with the Pennsylvania Public Utility Commission, or PPU. They are asking for an annual increase in water rates of about $20.3 million, which is a significant 28.9% increase. They are also seeking an increase in wastewater rates of about $3.8 million or 44.5%. They also utilize a Distribution System Improvement Charge, or DSI, which allows them to pass through certain infrastructure costs to customers without a full rate filing. This surcharge is capped at 5% of base rates. For the 3 months ended the 30th of September, 2025 revenues from the DSIC were $673,000. This mechanism helps them keep their infrastructure up to date. The company also discusses its pension plans. For the 9 months ended the 30th of September 2025, the net periodic pension cost recorded was actually zero. This is due to a combination of service costs, interest costs, and importantly, an expected return on plan assets which offset those costs. It seems they do not anticipate contributing to their pension plans in 2025. Under stock-based compensation, they talk about their long-term incentive plan, or LTIP. This is how they incentivize officers and employees with stock options and grants. They mention a new 2025 LTIP approved in May 2025, which added 150,000 shares available for grants. As of the 30th of September 2025, they had over 9.6 thousand shares in non-vested awards, with a weighted average grant date fair value of about $36. This is a standard practice for companies to attract and retain talent. Income taxes are always a complex part. They are benefiting from IRS tangible property regulations, which allow them to deduct certain asset improvement costs. This has led to lower effective tax rates. For the 3 months ended the 30th of September 2025, their tax rate was actually negative 10.4%, meaning they had a tax benefit. This is largely due to those deductions. There is also mention of a new law, the One Big Beautiful Bill Act. They are reviewing it but do not expect a significant impact. Now let's shift gears to the management's discussion and analysis. This is where the company's leaders explain the numbers and what they mean. They clearly acknowledge that some statements are forward-looking and actual results could differ. They highlight major risks like weather conditions, including droughts or heavy rain, which can impact water availability and usage. This is a key risk for any water company. Another significant factor is the level of rate relief granted by the PPU. Their ability to adjust rates directly impacts their revenue and profitability. The health of the local economy also matters. Commercial and industrial business activity affects water consumption and obviously their ability to pay for services. The company essentially provides water and wastewater collection and treatment services to a large area of south central Pennsylvania. They are regulated by the PPU, which means many of their decisions from pricing to financing need regulatory approval. It's good to see their water availability significantly exceeds their current consumption. On the 30th of September 2025, they had over 41 million gallons of daily availability compared to a usage of about 24 million gallons. That is a healthy buffer. In the results of operations section, they discuss the increase in net income for the third quarter of 2025 compared to 2024. This was driven by higher operating revenues and lower income taxes. They are seeing growth in their customer base. For water services, they served over 73,684 customers in the third quarter of 2025, an increase from the previous year. Wastewater systems also saw customer growth. Speaking of growth, they are actively pursuing acquisitions. They've signed agreements to purchase wastewater and water assets in Adams County and York County, with closings expected in 2026. While these are expected to be immaterial individually, they show a strategic effort to expand their reach. They invested over $37 million in construction expenditures for the first 9 months of 2025. This is critical for maintaining and upgrading the water infrastructure. They anticipate another $10 million in capital expenditures for the rest of the year. Under liquidity and capital resources, they explain how they manage cash. They use a cash management account linked to their line of credit to automatically pay down debt or borrow funds as needed, providing a dynamic way to manage their cash flow. Their capital structure is leaning slightly more towards debt, with common stockholders' equity making up 50.9% of total capitalization, compared to 52.6% last year. They aim to keep equity between 50 and 55%. A major positive is that Standard & Poor's affirmed their credit rating at a minus with a stable outlook. This is a strong rating and indicates good financial health and low risk. Alright, so what's the big picture here? The York Water Company is a stable, well-managed utility. They are growing their customer base both organically and through acquisitions. They are investing heavily in their infrastructure, which is essential for long-term success. Their financial performance is solid with consistent revenue and profitability. The pending rate increase request is a key element to watch, as it could significantly boost future revenues. However, any utility faces risks. Weather patterns, regulatory decisions, and the cost of maintaining and upgrading aging infrastructure are always factors. Their reliance on debt, while manageable given their credit rating, means they must continue to perform to meet their obligations. Overall, the York Water Company appears to be on a good track. They are essential service providers with a clear strategy for growth and infrastructure management, and their strong credit rating is a testament to their stability. What do you think about this report and the York Water Company's strategy? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more corporate deep dives. And definitely check out our Discord community linked in the description for more discussions. Thanks for watching, and we will see you next time.